This is Inside M&A with Dave Cantin.
Hey everyone, Jim Fitzpatrick. Thanks so much for joining me on another edition of Inside M&A with Dave Cantin. We're diving into private equity with some of the biggest names in the business. Joining us is Dave Cantin, President and CEO of the Dave Cantin Group, one of the largest and most forward-thinking automotive M&A firms in the nation. We're also talking with Mike Esposito, founder and co-managing partner of Franchise Equity Partners. Prior to founding FEP, Mike spent 28 years at Goldman Sachs in investment banking and was a partner for 20 years. And rounding out the experts is Mark LaNeve, who's been on our show before. He's the partner and chairman of the automotive vertical for Franchise Equity Partners. Prior to joining FEP, he enjoyed a very long career in the automotive industry, serving as president of Volvo North America and vice president of sales and marketing for both GM and Ford. Mark was also CMO of and head of agency relations for Allstate Insurance Company. And I think, Mark, you're the guy that gave us the world famous Mayhem, right?
I did, Jim, which is still running 14 years later, which I'm very proud of. And also my team back, I'm trying to remember the year, '05, we did the original employee discount for everyone, which kind of swept the nation, ended up in furniture stores and spas and everything else. So I got a few notches on the belt, I guess, would be the way to say it.
Yes, you do. I don't know that there's a dealer tuning in right now that doesn't know your name and your image and maybe even know you personally. So you've brought a lot to the table in retail automotive. So Mike, let me start with you if I can, for those that are not as familiar with Franchise Equity Partners as we are here at the show. How was it started and how do you currently help dealers grow and provide capital?
Great. Well, thanks, Jim. Thank you very much for having us.
Sure.
So we started Franchise Equity Partners about 3 years ago, and we focus exclusively on franchise industries. And we think about that broadly. So it's everything from restaurants to auto dealers, heavy equipment dealers, beverage distributors, and other consumer and business services. And what we found, while all those industries sound very different, they had some real common characteristics. There's a lot of family ownership.
Mm-hmm.
They tend to have really good cash-on-cash returns.
Mm-hmm.
They tend to be recession resistant, and they have affiliations with big brands, iconic brands. And all of the industries are undergoing consolidation. And I think all of those parameters fit the auto industry very, very well. And what we noticed was that there's not a lot of institutional capital in these different industries. And certainly there isn't much institutional capital in the auto dealer sector other than the public companies. And so what we realized is if we could create capital that was attractive to both the OEMs and to the dealers, we might have something very unique. And what's unique about our strategy is that we tend to invest in a style we call minority, passive, and permanent.
Okay.
And so unlike traditional institutional capital, we take a minority equity stake. We are relatively passive, and the thought process there is that the dealers have more skin in the game than us through their ownership. And they're the operators, we're not.
Mm-hmm.
We can invest for a very, very long-term horizon. And it's that style that enabled us to get into the auto franchising space and get the OEMs comfortable with us. We've made now 10 investments across the portfolio. We've got $1 billion fund.
Wow.
In the auto space, we own 2 platforms. Georgia Automotive Holdings, which is a group out of the New York metro area. They've got 15 rooftops in New York, New Jersey, Pennsylvania, and Connecticut. And the second is Parks Automotive Group, which is in the Carolinas, which also has about 15 rooftops.
Oh, wow.
So they've both been great investments for us and follow very much the style I was describing.
Sure. So can you talk about the range of private equity models out there and what makes them different and why your approach stands out?
Yeah, I think the thing that's unique about us in this minority, passive, and permanent approach is what we look to do is really leave the family and the dealer in control of the business. We have very limited control rights. And so we're looking for partners that are seeking partners themselves.
Mm-hmm.
If we're going to entrust our money in that kind of way, where we're very diluted, if you will, we want people that we can trust. We want people that are best-in-class operators, because again, we're not that. So best-in-class operators. Ultimately, we also like people that are very ambitious. and are eager to consolidate. And so those things, again, I think that style is unique. Traditional private equity will take control, will oftentimes kick out the family, and will look to flip the business after 5 years. Because that's what they do.
Sure.
And we found that that's neither appealing to the OEMs nor to the families.
Mark, with so many industries out there, why the automotive space? Just for some of the reasons that Mike just mentioned?
It's really been interesting, Jim, for me to be involved in and actually learn a little bit about some of the other industries like QSR, which is quick service restaurants, heavy equipment, health clubs, beer distributorships. It's been fascinating. But I think Mike Esposito was on the call with us and the other founding partner, Scott Romanoff. Their original premise was largely in auto. And because it's such a big slice of the American economy, the automotive industry, everywhere from manufacturing, right on through to the retailing of vehicles via the dealerships. And these are classically family-owned stores, typically built up over time where a dealer, when I first started in 1981, 95% of dealers had one store. And now it's largely consolidated where you still have a lot of single ownership, but the vast majority of the volume is going through dealers that own multiple stores or the public companies or what have you. And there was very limited private equity. In fact, as in my old job, running sales and marketing, both Ford and GM, we would have never approved the classic private equity acquisition for the reasons Mike gave. Lose control. They want to have a monetization event within 4, 5, 6 years.
Sure.
We trust the families to operate the businesses they've done for, in some cases, generations. We used to give a 100-year award out at Ford, and every year there were 7 or 8 families that had the Ford franchise for over 100 years. So
wow.
We're uniquely positioned to go in the use cases we like to talk about. Classic is the dealer wants to make an acquisition. Both of our current partnerships that Mike described were in that vein, where in an existing really nice platform looking to make a major acquisition, which we help fund, and then respread across the entire investment to get to below 50%. Other dealers, it's amazing that they've built these businesses up 1, 2 stores at a time and now have a platform worth hundreds of millions of dollars, but the vast majority, 85, 90, 95% of their personal wealth is in those stores and in a tight geography. So in many cases, we offer an opportunity for a dealer to diversify, where we'll buy a position and they can use that money for, to diversify their investments or, donate to build a hospital, whatever they want to use it for. And then the other use cases, in many cases, you have a partner that's been around for years or a family member that's not interested in being in the business and wants to monetize and exit the business, and we're able to step in and take out the minority partner. So we've had a lot of activity. As Mike said, COVID made it interesting because dealer profits were, very elevated during COVID. So getting to what the real run rate is, Dave Cantin could probably talk about that in better detail than me. But we think we're returning more to a normal state. We've had a lot of inbound activity. They're interested in any of the 3 use cases that I talked about. And we're excited for, the deals that we're currently working on and looking for more activity in 2025.
What are some of the key indicators, Mark, that a dealership is a good fit for investment? And then, of course, the flip side of that is, what are the red flags that would make a deal less attractive?
Well, the classic phrase of past performance is the best indicator of future performance, I think, is largely what drives us. As Mike said, we want to align. We're not looking. Many dealers that are really good operators look to buy a broken store and fix it, put their process and people in place. That's not us. We're looking to align with best-in-class operators. We really want to be geographic specific. As Mike said, we have an investment in the Carolinas. Actually, there are parts of Virginia, Pennsylvania, kind of the I-95 corridor of, Philadelphia up through the New York suburbs and even up into upstate New York. We'd also like to have a partner, obviously in Florida, Texas, Arizona's, the Rocky Mountain states. But we're not looking to have 3, 4 partners in the same area. We like, a little bit of geographic exclusivity, because once we're in, we like our partners to acquire more stores, which both of the existing investments have. So we're looking for a good brand mix, a really good best-in-class operator with a good management team. We love if they have a mindset of growth, a growth mindset, where we take on, additional investment together. and really get to know each other and the operation. And we feel like we can add some value in terms of analytics, banking relationships. Not just me, we have several other ex-OEM or partners that can provide some advice and counsel. And it's been a great kind of post-OEM career for me. I really, really enjoy it.
Dave, let me get you in on this. In what ways can a private equity investment transform a dealership's competitive positioning in the market?
Yeah, sure. Good question. And again, Mike and Mark, thanks for hopping on. And, look, your model is a phenomenal model because, a lot of these businesses that you guys are looking to acquire obviously are founder-owned companies. And founder-owned companies typically utilize resources internally to grow. But when they kind of really don't understand how they could go outside that internal process to grow, leveraging companies like franchise equity partners and the relationships behind that, it allows them to grow and to exceed expectations of what they're internally thinking. Here's what I mean, when I talk about, internally, externally being able to operate. Dealers do what they do really well, what they know well, right? They come in every day. They know how to sell and service very well. They know how to go out there and acquire a business really well that fits within their portfolio. What they don't really understand is how to then elevate from there and excel, cross-collateralize their business to be able to grow, not leveraging all their free cash. When you look at the opportunity to bring in private equity or family office or a good mutual fit, it allows that family to really utilize all their resources internally, their talent, their people, their greatest assets to grow their business and to eventually, take out some of their competitors.
Sure.
Picking dealerships that are surrounding their current platform where they have the area and expertise and the bench to grow, and then to look at different geographic locations of where they can expand. I'll tell you this, the greatest part I've heard so far about franchise equity partner is they're not looking at you as an investment, they're looking at you as a partnership. Yeah. And that's one of the most incredible things as a founder-owned company that you want to hear. And as I work with dealers and some of the largest groups out there, that's one of the things that's most important to them, to have a partnership and not to just be looked at as an investment. They look at their business as assets. Yeah. When you have dealers that have been doing this for a very long time, the sophisticated auto groups, best in class, as Mark and Mike says, those individuals do look at their car dealerships, their brick and mortar, as assets. And those assets need to be treated as such, where it is a partnership when you're considering, how do we elevate and take our business to that next level? How do we allow the next generation to be more successful than the current generation? How do we allow our group to keep excelling, to be able to compete in an industry that's constantly consolidating?
Yeah, for sure. Dave, I'll start with you, but I want to open this up to each one of you and get your opinion on this. This is a question that comes in constantly to the newsroom here at CBT News after we run segments like this, specifically, Dave, the show that you host here. And that is, in today's market, after coming off of the last 4 years, how do you value a dealership right now? How do you value a deal? And Dave, so I'll start with you, and then I'd like to get Mike and Mark in on that as well.
Sure. Look, it's a constant conversation, and we'll just go back to, when you look at what happened in the industry beginning in March 2020, when COVID first hit, nobody thought or realized at that time that in 6 months we're gonna have some of the greatest and most historical years in the automotive industry and profitability. Right. Everyone was planning for the worst. Yeah. Right, the worst outcomes, and little did you know, overnight, it kind of just exploded. Yeah. Well, here, at the end of the day, when gross margins go from 10% to 20%, and the only difference is, selling vehicles, right? It's not like we're adding more things into the process. Right. Eventually, that has to come down. So, look, we've experienced that decline towards the end of 23 into 24. I think we're more stabilized today. I think we're now able to predict again, which there wasn't much predictability over those 2.5, 3 years. So the only way to evaluate an acquisition, in our opinion today, is to look at a balance between a trailing 12 months and an annualized current year. So when we're looking at an acquisition today, or a group of acquisitions, what we look at is their trailing 12 months performance, and what they're tracking annualized for 24. And we kind of put that together, and we look at their performance metrics that are provided from the OEMs and from Jump IQ. And we look at that and say, okay, how are they performing to the market?
Yeah.
How are they performing to the expectations of the manufacturer? And how are they performing based upon what's happening in the last 12 months and trailing and tracking this year?
Mm-hmm.
So we typically don't go back and really analyze the evaluation aspect off of 21 or 22. We do like to look at pre-COVID numbers just to see what the store did then. You know, it's like anything else. I think dealers had the opportunity to learn a lot over the last 4 years.
Yeah, for sure.
They had the opportunity to learn the most over the last 12 months, because a lot of dealers were able to take a step back and start analyzing all their expenses, all their resources, everything that's going on with their businesses as they went from extremely high profitability back to some level of normalcy.
Mm-hmm.
And that created dealers to be more aware and more in tune of what's happening. So, you know, look, what we're seeing and what we're hearing in the space, we do a lot of work with the publicly traded companies and a lot of the very large privates. Everyone is pretty much in alignment with evaluating an acquisition off a combined trailing 12 months and an annualized current year.
Okay. And Mike, do you want to jump in on that? Is that pretty much the way you look at a deal?
Well, let me start by saying, if we only knew, we wish we had started this business in 2017, 18, 19, so we're the beneficiaries of the big run-up that took place. And shame on us, we didn't get our act together early enough. But you know, we did know it was a temporal phenomenon. And when we started the business, and to this day, we kind of approach valuation very much the same way, which is we're driven by returns. And what that means for us is we look at a longer term projection of the business, really over a 5-year period, to think about where can the business go. Now, that was in the past few years, that's basically saying, okay, peak earnings, and where are peak earnings going to go over the next 5 years? Now we're probably closer to normalized earnings. And so we build up a model, we build it up from the ground up, modeled out each of the departments, new, used, F&I, the parts and service department. We model up each of those revenue streams. We model up the expense base in some level of detail and come up with a long-term view of what EBITDA looks like, and then ultimately what returns look like on our money that we invest in a deal. We then usually triangulate that back to what's the simple multiple that equates to for each of the dealerships, because everybody has, you know, well-known multiples that they talk about, very much like Dave talked about in terms of the trailing 12 months, the run rate of where we are today.
Sure.
You know, one brand will trade at 9 times, one brand will trade at 5 times. And so we look at our valuations when we bring it back to today's value. We look at then what does that mean for multiples to make sure we're not off the market. And generally speaking, we find in most situations our return math actually brings it back to a place where the multiples that people talk about work for the seller.
Yeah. And Mark, I want to get your take on this, but what do you do when you get that ego-driven dealer that goes, look, in order to add to my collection here, I need a Porsche store, a Lexus store, a Toyota store, Mercedes, and I'll pay crazy numbers. Does that kind of throw the whole valuation thing out the door? Or?
That's an interesting question. It's been our experience so far, you know, and I like to joke, Jim, that, you know, probably over my career, I probably signed my name on proving 1,000 buy sells minimum.
Yeah, wow.
I never did one myself. So it's been a real education to actually dig in and.
All right, you've been on the other end.
Exactly, to dig in and do one. But what we've found is, you know, and I mentioned our 2 existing partners have both made acquisitions since we formed the partnership. I think about 3, 4, 5 stores each. Yeah. And we found that they're not too far off of our number. They didn't get to be big and successful by overpaying. Every now and then there'll be a certain reason, whether it's because it's a jewel like a Toyota, Honda, or Mercedes store in a certain location that's got a huge area to sell, that the dealer feels like he can boost profitability. But most of the time they fit into we get there from a ground up return focus. They get there more from understanding what kind of volume they can do and the formula and the kind of people that they'll put into the store to maximize profitability. But we're not too far off. Good dealers tend to operate very similarly. We found It was funny what Dave mentioned, March of 20, when I called it when the music stopped. It was like March 12th and 13th where everybody went home. And
That's right.
believe me, dealers were terrified.
I know.
In many parts, I was terrified.
Yeah.
In many parts of the country, they couldn't even be open. I remember
right.
New Jersey and some other places. But dealers do, and I said this to Mike and Scott when we first started talking, even before this fund was formed. The good dealers are resilient and they're smart, and they find a way to have a successful business despite economic fluctuations. Every brand has fluctuations. They have high points of new product, low points of new product. Dealers are resilient. They're smart. They're adaptable. They've learned how to sell online during COVID. The ones that hadn't embraced it had to embrace it. They learned how to schedule service outside the service drive, handle used cars in a different way. F&I has now become, it used to be like almost a sideshow. Now it's a prominent part of the business, and it's a system where a lot of the gains that were made during COVID, we're seeing sticking in terms of F&I, gross profit per unit.
Yeah,
So dealers are
that's right.
smart and resilient.
That's right.
Those are the ones we want to align with, and typically we're aligned on the price for acquisitions most of the time.
That's right.
I mean, look, I think that's why those are considered the best-in-class dealers. And at the end of the day, we say this all the time. Ultimately, market will dictate the evaluation, right? It's what somebody's willing to pay for.
Yeah.
But great dealers and great best-in-class dealers, will take their numbers off of what they know they could do with the business. They'll plug it into their pro forma, and that's how pretty much they create their evaluation. And that's how some of the more sophisticated auto groups keep winning when it comes to acquiring great assets and great businesses.
Sure. I just spoke to the president of a large auto group, and we were discussing the hot brands that are out there, and we talked about Porsche and Lexus, and his comment was, you can't pay enough for a well-run, high-volume Porsche store. What's your take on that comment, Dave?
Yeah, no, I completely agree. If I get one call every single day, it's where's the next Porsche store, right? I wish Porsche would just hand out an extra 100 points, right?
Right.
It is one of the most elite brands you could have.
Sure.
Great partnership in the manufacturer. Lexus as well, right? I mean, I've done a lot of. We just closed on a big Lexus store last week, but we do a lot of Lexus deals.
Yeah,
and I know it's one of the greatest assets you could have. You never. It's long term, right? It's something that once you have it and you get it running the right way,
right,
it's going to make you a lot of money for a very long time.
Sure.
Hey, Jim, I think we have 4 Porsche stores in our group. So if our partner ever decides to exit, send those people that'll pay anything our way. Okay, we like to meet them. But it is.
Hey, Mark, we got to talk after this call.
That's right. He's got the call coming in every day, he said. So
I don't think we're exiting anytime soon. It is a great brand and very passionate customers, and the OEM is terrific. So it's a great brand to have in the portfolio.
No question about it. Dave, let me get your take on this, and then Mike and Mark as well. And that is, how would you address one of the perceptions out there about doing deals with private equity, which is, how grueling it can be to get a deal done? Well, what do you say about that?
Sure. It really depends on the private equity, right? The kind of the relationship the private equity group has in the business.
Sure.
If they have experience of doing automotive acquisitions, it's going to be much easier. They know what they're looking for. It's not a grueling due diligence. They operate more towards a family office where, like Mike said, they don't need to sell the asset. Yeah. This isn't a 5-year investment. Right. So we look at that more towards like a private equity / family office acquisition, where they're more involved and engaged in the industry. They understand the industry. Mm-hmm. I think the old school private equity mentality, that perception from the OEM perspective to the dealer perspective, never really survived because of, you're bringing a group of individuals into the space that just care about the return on capital. That's all they're looking at. And unfortunately, this business is much broader than that. It's bigger than that. It's been around for a while and it's not going anywhere. And those great investors like Mike and Mark and their partners, they understand that it can't just be a 5-year investment. Yeah. And you have to be open to understanding that this is a founder-owned company. It's a company that's going to be around for hopefully generations to follow. Right. When you create a partnership and not just an investment, it's much easier for the current dealer to adapt and understand, and also the financial partner. Sure. So I think it's all the perception of how it's perceived, but also how that perception ultimately becomes reality.
Sure. Mike, do you want to add to that?
Yeah, I couldn't agree more with that. And let me answer that maybe in two ways. First, just in terms of what we need, what we require, oftentimes we'll get a book from people like Dave, and they're great. And that gives us, quite frankly, probably enough to do a preliminary view of value. When we don't, all we need to get is some monthly financial statements, monthly dealer statements that the dealers are already producing. And we're pretty good now at getting a valuation done. And from there, it's typical due diligence. It's quality of earnings on the accounting side. It's legal due diligence. But we don't think it's very onerous. We always say we can get to a legal agreement in 6 to 8 weeks.
Okay.
And then when we go through factory approvals, we've now been approved by, I think it's 15 OEMs. And so, we feel like we've got it really streamlined. We know exactly what we want, surgically go after that, and gets things done relatively quickly.
Right. Is Mark your secret weapon to get these deals done with the OEMs?
Mark is.
Stand back, boys. I know how this goes.
The OEMs have been terrific. They were inquisitive at first, wanted to understand it. And what they want to make sure is what I would have wanted to make sure when I was in those seats is that the dealer that we've known for years and his kids and his management team, his or hers, that they're remain in charge of the business. That they're making the decisions on the selling, on the facilities, on inventory, on selling and servicing, models, on making sure you're image compliant, you're investing in technology, and fixed operations have exploded as the cars have gotten more complicated with more onboard radar systems. So they got to have enough capacity.
Yeah.
So once they knew we understood that, to Dave's point, that we had, and it's not just me. Our day-to-day CEO of the auto business, a guy named Don Reese, he ran a couple big dealer groups. He had a background with Auto Nation. He ran Drive Time. We've got Rico DiGirolamo on the team. He ran Motors Holding, which actually propped up and put dealers in business for years.
Wow.
And then there's people like me in the other verticals. So Mike and Scott were, said right up front, we don't understand these businesses. We got to bring on some people that do. And I think that gives the OEMs and the dealers that we're talking to some comfort that these are not just financial folks. They really understand. They want to seek to understand our business, my business, and we can have an intelligent conversation about how to partner up and move forward.
Yeah.
Hey, can I just want to relate one other this topic, and I want to bring it back to something Dave said, which I think is important. A little bit of it is what's the upside of all this? And, we tend to view our money as a commodity. There's lots of people that have money, and we want to be a partner. Yeah. And we're not going to be an operator. We are never going to tell an auto dealer how to compensate his or her sales force. We're not going to be able to price used car inventory, but we like to be able to partner and add value in complementary ways. And I'll give you just a couple examples. One is Mark. Mark has got phenomenal relationships with OEMs, and it's clearly Ford and GM, but it goes well beyond that. And so that we can help a dealer navigate some of the OEM issues. Number two, we have an expert on our team that came out of the bank finance world. And so on every one of the deals we've done so far, we've refinanced the bank debt. We've gotten really good terms, great rates, great covenant packages. And so we can add that. We can become the corporate finance team for the dealer. And then finally, we've got a data science team. And so we've able to provide all kinds of interesting insights to our team. So as an example, we have a view about probably 85 to 90% of the dealer inventory sitting on dealer lots today. And so if you're a Chrysler dealer in Charlotte, North Carolina, we can tell you at every store surrounding you how many Ram 1500s are, how many this and that on each of the different brands and different models and makes. And it gives one a really good view of what's moving and what's not moving. Right. And again, we're not going to tell a dealer how to compensate their sales force, but we think we can add a lot of value in a partnership sort of way.
Sure. So Dave, when a dealer calls you and says, look, I've got 15 stores, I want to buy my competitor Crosstown, they have 10 or 12 stores, don't have all the capital necessary, I'm looking at maybe bringing on some debt. Do you pick up the phone to Mike and Mark and go, hey, this is a perfect scenario for you to come in on?
That's definitely a perfect scenario. I don't see a better one. I mean, obviously, what Mark and Mike are looking for are great best-in-class operators that run a good business and that are looking to grow from their business. I don't think the right fit is just for a group that's going to sit stagnant for the next 10, 15 years. I think growth is obviously the number one opportunity for everyone, and a group that wants to continue to grow and has the bench to grow and has the wherewithal to grow is the perfect partner for a Mark and Mike and franchise equity partners.
Yeah.
So yeah, absolutely, 100% agree.
Sure. What do you say to the dealer that says, well, instead of me giving up some of my equity in the deal, maybe I need to take a look at bringing on debt instead of doing that? What would your comeback to that be, Mike or Mark?
Quite frankly, I think that some debt is healthy. And what we've generally found is that auto dealers are very conservative, which is appealing. But some debt is healthy. But I think at some point, back to Mark's point, dealers are so concentrated in terms of their financial wealth in this asset.
Yeah, that's for sure.
And as a result, if I were them, I would want some debt, but not too much debt.
Yeah.
I also think that what we've found is because the auto industry is consolidating so much that at some point people run out of debt capacity, they run out of equity capacity. And so, again, we think that the most attractive place where we fit in is that sort of dealer that's at that point where they're continuing to grow, buy stores, but they're probably at their limit of the amount that they can finance with the banks.
Sure. Dave,
and also, I think a great fit there also, Mike, just to add to that, is the added value component of having a partner that has resources that they probably don't have at their disposal today. So you're picking up more than just capital, right? Mike, you said this comment earlier, you could get capital from a lot of different resources, right? You guys aren't the only ones, but you could probably add value to many auto groups that don't have the capability of adding that value or getting that value today on their own. Yeah. From your data science team to be able to look at analytics, very similar to Jump IQ, to be able to really look at what's happening in their markets, in their competitive markets. Data is the key today, right? That's where all the money is, right? Understanding how to perform. So I look at the partnership between you and your partners so much more than just the capital that they're taking off the table or the less debt that they have to put on the deal. And I do agree, a little debt is always good, but it's the added value. It's the 6 or 7 people that they could pick up the phone at any time and be like, hey, Mark, what do I do in this scenario with this OEM? Or Mike, what do I do in this scenario when the floor plan company is trying to raise me a half a point? You have some of the greatest people in business in all different, facets of the industry and surrounding industries at your disposal. Yeah. I mean, you know how much money that's worth right there? That's like the greatest strategic advisory team is your partnership. Sure. That is worth a huge amount of consideration when you're considering who your partners can be.
That's right. Let me ask you this, Mike and Mark, and that is that if a dealer works with you and they grow their company and you invest in their company and you take off a minority share and you're running and gunning and the dealer group is growing and the value is growing in these operations, do they have the option to buy back your stake at a later date for whatever the value of your stake is at that point in time, if in the event the family or the dealer felt as though, I think it's time that we own everything? Can they do that?
Yeah, I'll let Mike answer, kind of the technical parts of that question. But when we step into an investment, and I appreciate everything that Dave said, it's really nice. We like to hope that we're adding value and want to continue to add, the people and skills and technology to do that. But when we step in, we make sure that we're clear with the dealer that we're not traditional private equity. We're more like a family office. We are in for the long term. Yeah. That's what attracted us to the sector in the first place, is that, these are typically generational businesses. Sure. That have a family ethos to them that's been very successful over time, and we're in it for the long term. And I'll let Mike comment. We don't like to talk and get bogged down too much in an exit strategy, but providing we're hitting our return profile, yeah, the dealer at some point could take us out if they wanted to. I don't know, Mike, I'll kick it to you. Yeah.
We generally really want to be in these investments for a long period of time. We think that's in our interest, that we think that's in the dealer's interest. We think that's in the OEM's interest. And that's our goal. Generally speaking, not always, but generally speaking, we have what I would describe as a safety valve, some point distant in the future, where if things aren't going well, we'd be able to sell our stake and the dealer would have the right of first offer on the stake. Okay. And so that's generally built into all of our deals.
Okay. I would imagine you get phone calls from the son or daughter of dealer principals that say, I want to buy dad out. Dad wants to sell me. his share in the business, and will you fund that? Is that a common call that you get?
That is, absolutely is. And, again, it's true across all of our verticals, whether it be beer distributors or some of these restaurant operators. We spend a lot of time with families, and I always say families are tricky. And there's a lot of interesting family dynamics. You have in my family. I'm sure you have it in yours.
Oh, yeah. Oh, yes, I do.
In the dealer community. But yes, absolutely. And I think one of the best use cases for our capital is to facilitate the whole intergenerational wealth transfer.
Yeah.
Cashing out the mom and the dad, cashing out the sister-in-law that are no longer involved in the business. And that is absolutely one of our use cases, and we've done a few of those types of transactions.
Sure. But there's nothing to worry about because we know every single dealer that's listening to us today has a clear succession plan, right? For all of their kids and grandkids.
Minus 50% of the age.
That's exactly right. Dave, switching gears a little bit here, there's been obviously a lot of M&A activity over the course of the last 3 years. You and I have talked about it, at great length and with so many dealers and some high prices paid for dealerships. Give us a kind of an update from your perspective as we sit here today on this call. Where does the market stand right now? Good time to sell, bad time to sell? Where does that stand?
Yeah, look, I think the end of 24, I would say Q3 and Q4 was a tricky quarter. A lot of groups were just working on getting their house in order, right? Yeah. Internal, infrastructure, things of that nature. If there was a great opportunity or acquisition, they took advantage of it.
Yeah.
If there was a major distraction, they would divest it. Okay. Dealers tend to spend the most amount of their time on the dealerships that are not doing so well and that need their attention. And those are considered distractions. No different than if you were sitting with a management advisor and 87% of your portfolio was overperforming and 13% was underperforming. You'd want to look at how you can transfer that 13% and make it performing.
Right.
Same thing that we do with our clients, right? So that's a constant. It's always happening. I will tell you there has been a huge uptick just in the last few weeks of dealers now saying, okay, we want to go into 25. We want to sit down. We want to work through a plan. Which dealership should we consider as a divestiture to maybe take some capital and reinvest it in areas where we know we could do better? Mm-hmm. Over the last 12 months, dealers have experienced in new geographic locations more than ever before. They're instead of just saying, I want another store next to my 10 or 12, they're now open to going into markets that they never considered before. Of course, everyone wants the same markets: Florida, Texas, Nevada, just right down, just go right down the line.
Right.
Wants the same states. With that being said, we expect 25 to be an incredibly busy year ahead in M&A. I think a lot of dealer groups that were considering an acquisition waited, sat on the sideline, got their house in order, worked on their infrastructure and growth. But there's a lot of cash sitting there. And there's a lot of, between the publics and privates, there's a lot of, call it the ability to execute quickly with capital. And I think there are a lot of sellers that were still considering over the last 3.5 years, because, let's face it, there is half the dealers don't have a succession plan, that were in between. What do I do, right? Should I sell now? Should I not sell now? What should we do?
Right.
I think cap gains increase was a great fear for everyone.
Yeah.
Okay. Now we're past that fear. So I think we're going to see a lot of great acquisitions in 25. We probably had more meetings in the past 3 weeks discussing some great opportunities than we did in the past 9 months.
Wow, that's great. And I know that, NADA says the average age of today's dealer principal is 69 and a half years old. Many of them are nervous about what the new administration coming in. While Trump's got a lot of great ideas and is very pro-business, he keeps throwing that tariff word out there. And I think it's got the industry in a little bit of a knot. And I spoke to one dealer. He goes, I survived in 2008, 2009. I survived COVID. I survived the ups and downs. I think 2025 might be the year for me to maybe step aside and let somebody else take the helm here and take the dealerships or buy the dealerships. Have you gotten calls like that because of the uncertainty out there?
Yeah, I think, look, uncertainty is one of the greatest key factors of what creates those phone calls. How many more times can you experience what we've gone through in just in the past, 10, 12 years? Maybe I should say that. I should knock on wood.
Right.
But look, this is a business and it's a cycle, right? Mark and Mike knows what I mean by that. This industry is a cycle. You're going to have your great years. You're going to have your so-called decent years, but it's a cycle and we live in this cycle. And dealers that have been in this for a long time, Mark, you utilized this word earlier. They are some of the most resilient entrepreneurs of any industry. And their level of tenacity to dig deep and want to be in this business is more about passion than anything. And it's really not age related to make the decision. It's when you're ready. The next generation maybe just doesn't have the desire to do what the last 2 or 3 generations did.
Sure.
The management team just doesn't have the financial capabilities to take you out. It really comes down to the time. Is it your time? Are you ready to pass the torch? Who then will carry out that legacy? Yep. And that's what's most important. But we do believe 25, we're going to see some significant, incredible opportunities and acquisitions that are going to hit the market.
Do you think we'll see the Publix get back in a big way?
I do. I think the Publix have done a great job of getting their houses in order and done a great job of buying back a lot of their stock. But there's a lot of capital sitting there. So I believe that every one of them, or not all of them, but a majority of them are going to make some significant moves in Q1 and 2. And we'll see a lot of activity flow to kick off the year.
Sure. You all sit at a great spot to ask this question, and I know that my viewers want me to ask you, so I want to get your take on what you think of the year ahead and what your predictions are for the industry. And Mark, I'd like to start with you, and then we'll kind of go with Mike and Dave, and because I there's many people that are feeling 2025 is going to be a pretty good year. What's your take on that, Mark?
Yeah, we're bullish on 2025. It's funny, when I was in the OEM, I really based 90% of the way I thought about it on what the overall level of the selling rate, the SAR would be. It was going to be an 18 million unit industry, 17. Now I'm obviously a little more concerned on on dealer profitability. But if you think about new vehicles should be up 25 versus 24, just basically looking at economics and, the fact that interest rates hopefully will not go up, chance that they will come down, which always helps. As I mentioned, F&I has become very institutionalized, very well managed at the dealer level. They're continuing to provide, newer type of products, a lot of technology to add value for the customer. A lot of the fixed improvements that we've seen, both in terms of volume, turns, and approved labor rates, we believe sticks. The vehicles are more expensive than ever. They went up about $10,000 on average during the COVID years, but they got unbelievable. I just was in Florida and I rented, a Kia Kona, and the technology in that vehicle, I don't know the exact price point, I think it's under 30 grand, was unbelievable. Yeah. I mean, it was truly unbelievable, the amount of onboard cameras and radar detection. And these things are difficult to fix at a shade tree garage. So, more and more customers are coming back to the dealers. They do a terrific job. A lot of them are putting in quick service capability, which also helps, taking advantage of online selling to get their cost base and, really getting a grip on digital marketing. So we're bullish on the industry. We think the OEMs are going to continue to innovate. Still some sorting out to do on how much is going to be electric versus non-electric. That's the dealers feel a little bit boomeranged depending on the brand on the last few years with that. But I think there will be clarity, especially with the Trump administration. Yeah. And, we think it's going to be a good year. That's why we're looking. We've got hundreds of millions of dollars in the ground, and we got hundreds of millions sitting on the sideline waiting to invest. We're looking forward to it.
That's great. Mike, what's your take on the year ahead?
I hate to look into crystal balls because generally I'm bad. But I think the equity market is a really good predictor. It's a voting machine, and the equity market's hovering around all-time highs. And there's undoubtedly a lot of things to worry about. There's undoubtedly a lot of potential political volatility. But I think in general, people are betting, and if I were a betting man, I would bet that Trump will be good for business. Yeah. He too will be informed by the stock market, be enthusiastic about it as a voting machine, and try to do everything we can to see the stock market go up. I think also interest rates are more likely than not to keep trending down. There's a lot of debate on that. We'll see what the Fed does this afternoon on that issue. Yeah. But I think the picture will probably be better. So we're optimistic. I think we certainly saw in 24 across our businesses a stretched consumer. SAR in the auto industry didn't get back to 17 million units. When we look at our fast food businesses, when we're in Taco Bell, we're in Buffalo Wild Wings, we're in Auntie Anne's, we definitely saw some tough trends in traffic patterns and the like, but that seems to be actually reversing itself. So we're optimistic on the equity market, the rate picture, the consumer, and then finally, there's been a massive change in dealer inventory. When you think about our world and where we came into 24 and where we ended up 24, that's actually stabilized quite a bit over the last 3 months. It was skyrocketing and now it's stabilized. And so hopefully that's kind of going to level set, help stabilize GPUs, which will then put the industry at a good footing to come into 2025.
Sure. Thanks for that, Mike. Now I'm extremely hungry. But
hey, Jim, I wanted to just add in on tariffs.
Sure.
Is from an OEM perspective, which obviously flows through to the dealer. They've been in place for years. This is not a new thing.
Right.
And, they were in place in Trump's first administration, very little inflation. They were in place before Trump's first administration. And they're really complicated. These are global supply bases. There's ins and outs on every product that gets built. You could be supplying certain things from Asia, from Europe, North America, United States, Mexico, Canada. So the industry tends, just because there's tariffs doesn't mean there's immediately going to get added to the price of vehicles. These things tend to equalize and sort themselves out. There's smart people involved in the government and OEMs managing these things. So it's something to keep an eye on. But I certainly, me personally, am not thinking this is going to be a disruptive force in the industry. I think, if anything, the new administration, to Mike's point, will be good for the industry.
One dealer I spoke to said this is no more than a ploy that Donald Trump is using as a tool to bring these people, these countries to the table to go, look, let's level the playing field here, right? And we're not really going to see the tariffs,
Agreed. So, and let's face it, these tariffs have been around. It's not new, right? We're not looking at something that's being invented or created today.
Yeah. Dave, let me get your take on the year ahead, and I'll let you close out our session today.
Yeah, Jim, thanks. And again, Mark and Mike, thank you so much for today's session. I think the audience definitely got a great 45 minutes together. So this is great. And a lot of knowledge.
Yeah,
so thank you very much. Look, I'll say it like this. If we all were able to say in 2018 and 19, we could just repeat those years over and over and over again, everyone in the industry would have raised their hand and said, I'll take it.
Yeah.
Right? No one would have expected to happen what happened in 21, 22, and most of 23. And that anomaly becomes something that is like a creature of habit. We want it over and over. And everyone knew eventually that was going to end. All right. It was inevitable. It was going to come back down to a level of normalcy of 18 or 19. So what does that mean for 25? I think 25 is going to be better than 19. Mm-hmm. So if everyone was excited and they would have raised their hand to take 19 over again, they're going to be happy with 25. 25 is going to be a powerful year in the industry. I think there's going to be a lot more positive than negative. I do believe, to Mike's point, we'll start seeing rates go back down, and that will help dealers in many ways, and our consumers keep coming in the door and buying and leasing vehicles. I believe, to Mark's point, F&I is a huge factor in the industry today. It's being taken a lot more serious than ever before. It's a significant component of dealer profitability. And I think more dealers than ever are also focusing on their infrastructure and maximizing their fixed ops. Let's face it, if you could find a way to maximize your absorption, you're going to make a lot more money. And fixed ops, again, to Mark's point, these cars are so technology driven today. They're not going to their local garage, if something goes wrong with their car. They're going to bring it back to the dealer.
Yeah.
So, as savvy as these OEMs are in building these cars and creating these cars, they do break, right? Things happen to them. So the dealers are going to continue to do well in fixed ops. And I do think 25 is going to be an incredibly successful year for the industry. I can't guarantee that for all manufacturers, but for the majority, they're going to do very well.
Yeah, I would agree. Dave Cantin, President and CEO of the Dave Cantin Group, Mike Esposito, founder and co-managing partner of Franchise Equity Partners, and Mark LaNeve, who's the partner and chairman of the auto dealership vertical for Franchise Equity Partners. Gentlemen, thank you so much for joining me on the show. I very much appreciate it. I know that our viewers and our dealers that will get a lot out of our show today. So thanks so much.
Thank you, Jim. Thanks, Dave, too. Appreciate it. Thanks. Thanks for the opportunity.
Yep.
Thank you, gentlemen. Appreciate you guys.
Awesome.
Thanks for watching Inside M&A with Dave Cantin, exclusively on the CBT Automotive Network. The Dave Cantin Group is the nation's leading advisory company in the automotive industry. To contact a mergers and acquisitions advisor from the Dave Cantin Group, visit davecantingroup.com.